Okay, so in the last class, we were discussing our chapter of basic income tax calculation. I hope you all remember, and you all must have done a revision also. So in this chapter, we discussed that how a tax return looks like. We discussed three heads of income: non-saving, saving, dividend. We had a discussion on personal allowances, tax bands, real estate investment trust. On every step, we were doing practice questions. Then we had a discussion on dividend income, the profit distribution from the company. And in dividend income, we looked at first 2,000 of dividend income is always taxed at 0%. We looked at the concept of trust income. Today, we'll be looking at practice questions. So if I give a brief recap that what trust is, so I hope you all remember that trust is a body which was created by a donor in which he gives the assets. Those assets were managed by the trustees for the benefit of beneficiaries. Why trust was created? To give income to those who cannot manage it, or when you want income to be distributed in a systematic manner, or when we intend to do income tax planning. Now, what do you mean by income tax planning is that when we create a trust, we distribute the income among multiple beneficiaries so that we can use their personal allowances and basic rate bands. Another objective was to do inheritance tax planning, that when we create a trust, the assets do not remain in ownership of a particular person, so that when he dies, there will be no inheritance tax because the assets are on ownership of a trust. I hope you all remember this. Then we discussed the concept of discretionary trust, which operates according to the discretion of trustees. The objective of discretionary trust is to do tax planning. Normally, the donor himself becomes the trustee. I hope you all remember 45% withholding tax, classified in non-saving income, taxed on receipt basis. And then we talked about interest in possession trust, that here the trustees are just an employee and they have to follow the instructions of the donor given in the will or in the trust constitution. Here the beneficiaries have rights. Trustees are bound to follow the instructions. It will be taxed under non-saving income if the trust earns from non-saving or saving sources. Withholding tax was 20%. If the trust earns from dividend income, it was taxed under dividend head and withholding was 7.5%. We had a discussion on theoretical narrative in the previous class. I hope you all remember. And if you have any query, you can ask me on my WhatsApp number. Today, we will be doing 4 practice questions, which will include issues relating to trust. I want you all to concentrate on it so that if someone has any query, it will get clear. Now, Mr. Z has following incomes for the year. Now, what are the incomes? Trading income, 17,000. Income received from discretionary trust. On discretionary trust, the withholding tax is 45%. And since the examiner is silent, so we will assume it as net. Okay. Now, dividend income is 25,000. We have to calculate the tax payable. So one head of income is non-saving in this question, and the other one is dividend. Okay, listen to me carefully, please. Trading income. What is the amount of trading income? So it is 17,000. It goes in head of non-saving. Then we have income received from discretionary trust. Since the withholding tax is 45%, so what we have received is 55%. So we need to gross it up. See, what you need to understand is that if the withholding tax, the advanced tax was 45%, what we will receive is 55%. So the gross amount will be 16,363. And then we have dividend income on which there is no withholding tax. It goes under head of dividend and it will be 25,000. So Mr. Z had three incomes. One was trading income, which goes in head of non-saving. Second one was discretionary trust. I hope you all remember that discretionary trust is a trust which operates according to the discretion of the trustees. It operates according to the discretion of the trustees. Trustees had full powers in this trust. Normally, the donor himself becomes the trustee. The concept of discretionary trust is used to do income tax planning, that we change the beneficiaries, we change the income distributions in order to save inheritance tax. And the income tax, we want to use income tax bands and personal allowances. We discussed all in the previous class. Now, in the discretionary trust, the withholding tax is 45%. It is taxed on receipt basis, and it is assessed under non-saving income. Okay, so in this question, there was trading income, which went in the non-saving head. There was discretionary trust, which is also a non-saving income. Withholding tax was 45%. Now, if withhold, the advanced tax is 45. So we will gross it up by dividing it with 55 and multiplying it with 100. And dividend income is 25,000. If I add up all of the incomes, this will give me total income of how much? 17,000 plus 16, 363. So it is 33,363, and this is 25,000. Then personal allowance. The personal allowance is 12570. This is the routine work. We have done it multiple times. Now this will give us the taxable income. The taxable income will be 33,363 minus 12570. So it will be 20,793. And here the dividend is 25,000. Now we will apply tax on it. Non-saving income 20,793. This goes in non-saving head. The basic rate band is still 37,700. So the entire amount will go in the basic rate band. I hope that this all is routine and you all remember the basic workings. Okay. Non-saving income 20,793. The basic rate band is still 37,700. Now the dividend income is 25,000. You all know that first 2,000 of dividend income is always taxed at 0%. So this gives us 0. Now you will look at the basic rate band, that what amount is remaining in the basic rate band. Because apparently we can see that the first band will be consumed. 37,700 minus 20,793 minus 2,000. So the remaining amount in the basic rate band is 14,907. Dividend income is taxed at 7.5% in basic rate band. So this gives me 1,118. And the remaining dividend income will go in the higher rate band. So 25,000 minus 2,000 minus 14,907. So it's 8,093. In higher rate band, the rate is 32.5%. So this gives me tax of 2,630. So now the tax liability is, now the tax liability is 4159, 1118, and 2630. So 7907. What about the advanced tax on discretionary trust? The advanced tax on discretionary trust, which we grossed up, 16,363 minus 9,000. So that was 7,363. So this gives us the tax payable of how much? 7,907. So it's 544. I will repeat it again. I want you all to listen to me very carefully. In the previous class, we had a discussion on rules relating to trust. In the today's class, we are doing practice questions on it so that you people can have a clarity. There was trading income of 17,000. Income received from discretionary trust. Now, in case of discretionary trust, withholding tax is 45%. And since the examiner is silent, so we are assuming it as net. Dividend income is 25,000. Trading goes in non-saving. Discretionary trust is always a non-saving income. Since withholding tax is 45%, so we grossed it up by dividing it with 55 and multiplying it with 100. And then the dividend income goes in head of dividend. This gives us the total income, personal allowance, and here is the taxable income. Non-saving taxable income goes in basic rate band. Dividend income, first 2,000 on the 0% band. Remaining band, 7.5%, and the last one goes at 32.5. So if you remember the discussion which we did in the previous class, see, one is the theoretical narrative. Now, my approach is that I don't ask my students to read the book. All the theory I discuss in the class. So what the trust is, why it is created, we discussed it in the previous class. Then what is discretionary trust? It operates according to the discretion of the trustees. Why is it created? It is created for tax planning, income tax planning, so that the income is distributed among multiple beneficiaries to use their personal allowances and basic rate band. Now, this can be done in discretionary trust because trustees can change anything. They look at the planning every year. But in interest in possession trust, they are just an employee and they have to follow the instructions originally given. So I discuss the theoretical narrative, I discuss the calculation aspects, and then we do the practice questions so that you people can have a confidence that how you have to deal with the scenarios. I hope that you people are getting it. In this question, there was trading income, discretionary trust, 45% withholding. So we grossed it up. There was dividend income, total income, allowance, and the tax. Is it clear? Let's look at one question. We'll look at practice question 9 in a while. Currently, we are doing the 10th one because it is similar to question number 8 so that you can have an idea before we introduce the interest in possession calculations. Mr. J has following incomes for the year. The property income is 18,000. Income received from DT is 10,000. Dividend income is 20,000. Now, we will make the heads. The first head is non-saving. Still, we haven't studied the saving income. So, non-saving and dividend head. Property income. How much is the property income? It is 18,000. It goes in head of non-saving. Income received from discretionary trust. The withholding tax is 45%. And since the examiner is silent, so we will assume it as net. So 10,000 divided by 55%. 45% is the withholding. So 10,000 divided by 55% multiplied by 100. So it is 18,181. And then we have dividend income, which goes in head of dividend, and that is 20,000. So the first step is to classify the incomes correctly. If there is any withholding taxes, we need to gross it up. Okay, property income goes in head of non-saving discretionary trust. We crossed it up and we classified it in head of non-saving, and then we had dividend income. Now, when we add up all of them, we arrive at the value of total income. So this is 36,181. This is 20,000. Now we will deduct the personal allowance, which is a routine activity. The personal allowance is 12,570. So this gives us the taxable income of how much? Taxable income. So here it will be 36,181 minus 12,570. So it's 23,611, and this is 20,000. Now we have to apply the tax, which is again a routine activity. Non-saving income, 23,611, entirely in the basic rate band, because the basic rate band is still 37,700. So this gives me 4,722. Now we have dividend income, which is 20,000. Always, first 2,000 of dividend income goes at 0% band, always. Now, irrespective of whether you are a basic rate taxpayer or whether you are a higher rate taxpayer or whether you are additional rate taxpayer, first 2,000 of dividend income always go at 0% band. Now, let's look at the basic rate band, how much is remaining. So if I look at my basic rate band, 37,700 is the band, 23611 minus 2,000. So 12089. Now on dividend in basic rate band, the rate of tax is 7.5%. So this gives me 907. Now what about the remaining dividend? 20,000 minus 2,000 taxed at 0%, minus 12089 taxed at basic rate band. The remaining 5,911 will be taxed at higher rate band at rate of 32.5%. So this will give me 1921. So my tax liability will be 4722 plus 907 plus 1921. So it will be 7550. Then we will deduct the advanced tax, the tax credit from it. What was the tax credit? 8181. Now, when we deduct the advanced tax from it, this gives us a tax payable which has become negative. Now, when it has become negative, we will get a refund of the tax. So nothing to worry about. We can get a refund. So 631 is the refund. Okay. So if you look at this question, I think again, it was a simple one. Now, the narrative of the trust is something different, but when we look at the calculation aspect, it is pretty much simple. It is like a routine question. Just one thing to remember, that if it is a discretionary trust, we need to gross it up because the withholding tax is 45%. Okay. So if you look at this question, there was property income, which went in non-saving, discretionary trust, which was grossed up, dividend income in the head of dividend. We arrived at the value of total income. We deducted the personal allowance to arrive at the value of taxable income. Okay, and then we simply calculated the tax. Okay, now non-saving income was entirely in the basic rate band of 37,700. So 23611 taxed at 20% because it lies in the basic rate band. Dividend income, first 2,000 always taxed at 0%. Then the remaining value in the band. The basic rate is 7.5% and the remaining dividend goes at the higher rate. So again, I would say it is a simple thing, but you obviously need to remember the theoretical narrative also. What is trust? It is a body in which the donor gives the asset. Those assets are managed by the trustees for the benefit of beneficiary. Okay. Why do we create trust? Because we want to give income to those who cannot manage it. Or maybe we want to give income in a systematic manner. Okay, now these two are the legitimate reasons. These two are the legitimate reasons that we want to give income to someone who cannot manage it, or we want to give income in a systematic manner. These two are pretty much legitimate, the reasons which I would say non-tax reasons. But yes, through the concept of trust, we can do tax planning also. That if we create a discretionary trust, we ourselves become the trustee, then we can use trust as a tool to do income tax planning. Because in discretionary trust, the donor himself becomes the trustee. Now everything is on his discretion. He can change the trustees, he can change the distribution. And by using this concept, what he can do is he can use the basic rate bands and allowances of multiple beneficiaries, obviously within his own family. You can use it with anyone also, but obviously use this concept for tax planning. From tax perspective, for the beneficiary, it will be a non-saving income. It will be taxed on receipt basis. Withholding tax will be 45%. We discussed this all in the previous class. I just give revision along with the calculation so that you people can learn the rules and these things get settled in your mind. And then we discussed interest in possession trust. Now, interest in possession trust, where trustees are just an employee. The donor gives the asset, he gives the instructions in his will or in the trust constitution. Trustees just have to follow those instructions. Now here they cannot change the things to do tax planning. They just have to follow the instructions. Now the beneficiaries have rights. They are taxed on accrual basis. But the beneficiaries have rights. They are taxed on accrual basis. If the trust earns from non-saving or saving sources, if the trust earns from non-saving or saving sources, for the beneficiary, it will be taxed under non-saving income. This is the default category. If the examiner is silent, we include it in non-saving, and withholding tax is 20%. If the trust earns from dividend sources, then withholding tax will be 7.5%, and now it will be taxed under dividend income head. Let's look at a practice question on IIP. Mr. Z has following income. Property income is 16,500. Income received from IIP 8,000. Now he is silent, so we will assume it in non-saving source. And we will assume withholding tax of 20%. Now this is a default assumption which will be used normally. Whenever the examiner is silent, we will use this default assumption. Whenever the examiner will be silent, we will use this default assumption that IIP will be included in non-saving source and withholding tax will be 20%. This is the default assumption which will be used normally. The dividend income is 37,000. Let's look at it. One head of income is non-saving. Please listen to me. And the other one we are creating is dividend. Okay. Property income, 16,500. Simply goes in head of non-saving. IIP, Since the examiner is silent, we will consider it as a non-saving source. The withholding tax in non-saving source is 20% in IIP. If the IIP earns from non-saving or saving sources, we include it as a non-saving income for the beneficiary, and withholding tax is 20%. So the gross amount will be 10,000 and the dividend income will be 37,000. Okay, now this will give us the total income. Now again, the question is a normal routine question. The total income is 26,500. Dividend is 37,000. We will deduct personal allowance from here. The personal allowance is 12570. So this gives us the taxable income. Now, the taxable income will be 26,500 minus 12570. So it's 13,930, and this will be 37,000. Now let's apply the tax. Non-saving income is 13,930. In the basic rate band, the basic rate band is still 37,700. So this will go in the basic rate band. The tax will be 2,786. Dividend income is 37,000. Always the first 2,000 gets taxed at 0%. This gives 0. Now look at the remaining space. Look at the remaining space in basic rate band. The basic rate band is still 37,700. 13,930 minus 2,000. So 21,770 is remaining. In basic rate band, dividend is taxed at 7.5%. So this is 1633. And the remaining dividend, 37,000 minus 2,000 minus 21770. The remaining dividend, 13,230, will be taxed at higher rate band of 32.5%, 4,300. So this all is pretty much normal. We have done it multiple times. So this gives us the tax liability 2786, 1633, and 4,300. So it's 8719. We will deduct the advance tax, the tax credit from it, to arrive at the value of tax payable. Now, what was the tax credit here? In IIP, it was 20% since it was a non-saving source. So the credit was 2,000, which gives us payable of 6719. So I will repeat it again. This practice question was pretty much simple. Interest in possession trust was involved here. Now, in case of interest in possession trust, if the examiner is silent, we assume it as a non-saving source. The withholding tax was 20%. Okay. Now, the rest of the question was simple. Property income, IIP, grossed up, dividend, total income, personal allowance, taxable income, and the tax bands. So if you look at the calculation perspective, it has been just a repetition. What I'm trying to do is I add each of the concept and then I make you go through multiple practice questions so that the things get clear for you. The things gets hands-on. Okay. Let's look at one last practice question on this issue before we introduce a new concept of interest income. Okay. Let's look at one last practice question on this matter. Okay, so in practice question number 11, he's saying that Mr. J has following incomes. Let's look at it. Employment income 26,000. Income received from IIP 8,000. Now, since he is silent, so we will assume it as a non-saving source, and withholding tax will be 20%. Then income received from DT is 15,000. DT always withholding tax is 45%, and it is always a non-saving income. And then we have dividend income of 27,000. Let's look at the question. I want you all to concentrate on it. There will be two heads of income involved. One is non-saving. And obviously, we haven't studied the saving income, the interest income yet. So till here, the questions involve only dividend income. Now, the employment income goes in non-saving, 26,000. Okay. Income received from IIP, 8,000. Since the examiner is silent, so we will assume it as a non-saving source. Withholding tax is 20%, so we will gross it up by 80%. So this gives me 10,000. Discretionary trust, 15,000. Now on discretionary trust, the withholding tax is 45%. So we will gross it up by 55%. So 15,000 divided by 55% multiplied by 100%. So this gives me 27,272. And then we have dividend income, which is 27,000. So if you look at it carefully, you will be able to understand in a better manner. What we have done is the employment income was 26,000. The employment income was 26,000. Interest in possession trust, it was non-saving source. Since the examiner was silent, the withholding tax was 20%. So we grossed it up by 80%. Then in discretionary trust, it is always 45% withholding. And then we have dividend income. So if we add up all of them, now the question is a routine, simple question. This will give us a total income. 26,000 plus 10,000 plus 27,272. So it's 63,272. And this is 27,000. Now we will deduct personal allowance from here. The personal allowance is 12,570. So this gives me taxable income. Okay. So our taxable income will be 12,570 allowance will be deducted. So this gives me 50,702. And here it will be 27,000. So let's apply the tax. Non-saving income is 50,702. The basic rate band goes till 37,700. So 37,700 into 20%, this gives us 7,540. Now in this question, the whole basic rate band is used in non-saving income. Still the non-saving income is remaining. So now it will go in the higher rate band, which continues till 150,000. 50,702 minus 37,700. So it's 13,002. We will apply 40% on it. So this gives us 5,201. And then we have dividend income, which is 27,000. On the first 2,000 of dividend income, it is always 0%. And since the basic rate band is already used, so the dividend income will now go at higher rate, which is 32.5%. So it's 8125. So I think it's a routine question. The first 37,700 goes at 20%. The remaining goes in the higher rate band. Dividend goes in 0%, first 2,000, and the remaining dividend goes in higher rate band since the basic rate band was already used. So this gives me tax liability 7540, 5201, and 8125. So it's 20866. We will deduct the advanced tax, the tax credit from here, to arrive at the value of tax payable. So the tax credit in this question were two credits. One was on IIP, which was 2,000, and one was on discretionary trust. Okay, so one is 2,000 and the other one is 12272. You can do it on your calculator. 12272. So the tax payable will be minus 2,000 and 12272. So this gives me 6594. Okay, so if you look at the question, there was a non-saving source and there was dividend source. Employment income went in the normal way. For IIP, since the examiner was silent, so we classified it in non-saving source. The withholding tax was 20%. Then we had discretionary trust, dividend income, and rest of the question was done in the normal manner. So if I give you a brief review of this chapter till here, we started with the basic tax return. We looked at non-saving income. We looked at the rules of personal allowances. We looked at the tax bands. Then we had a discussion on real estate investment trust, the mutual fund. We discussed the rules relating to dividend income. And then we had a discussion on trust income. And in the today's session, we discussed 4 practice questions on trust. So I hope that you people are getting it till here. What I want from you people is to revise it. In the next class, we'll have a discussion on interest income. So these all are the small issues which are added in the tax return. Then we'll discuss qualifying loan interest, planning of personal allowances, qualifying donations, and then this chapter will be completed. So it is basic tax calculation. We are looking at how a basic tax return is made. Okay, so I hope that you people are getting it. We will continue in the next class with the concept of interest income. Okay, thank you.